Hello and welcome to this edition of the video market update from Orbex.com. So Donald Trump actually failed to pass the healthcare bill in his first vote in the House of Representatives ever. This is despite the fact that also the majority of the House are Republicans, yet they also failed to pass the bill. They said in the press conference that they were just a little short on votes, but they decided to pull the bill, and they even will have to live with Obamacare also for a long time, or for some time now. But this is a bit confusing, and it also raises a lot of questions. If they were just a little short on or a little bit short on votes, they should have delayed at least the bill or a little bit, and even to try and renegotiate with the House to pass the bill even later. But it seems that there were no majority at the House and at all, and that's basically, it shows that they were even very short on votes. If you're asking why even the markets are declining right now across the board, well, it was supposed to be good news for equities, and this was also the last reaction that we saw in equities on Fridays, at least for the US equities before the closing bell. However, concerns right now are rising toward the next bill, which is the tax reform bill, or even the infrastructure spending bill. We don't know when it will be raised, or even if it's going to pass it. The market is now even concerned that Trump might not be able even to pass this bill as well, and if so, this would create a lot of mess in the market and even in the States. Therefore, the market might keep on declining for the next few weeks, and on such fear in the coming weeks, until we get at least some sort of a bright light at the end of the tunnel. Going into the UK now, this week, Article 50 will be triggered, according to the latest statement by the British Prime Minister Theresa May. However, don't expect the pound to crash or even be confused if the British pound also advances across the board in the next few days, because, again, the impact is already there and it's already priced in since the referendum back or last year. So don't rush into any kind of shorts as of yet. However, the pound is likely to remain weak for the next few months, but the weaker US dollar, or the expectation of a weaker dollar in the next few months, might lead to only a gradual decline in the British pound, and only a gradual decline. As for this week's fundamentals, Monday was pretty calm day, as there were only few economic figures from Europe, which is the German IFO, which came in also much better than expected. But this week is also expected to be very short on fundamentals. But tomorrow we will be watching the US consumer confidence, while there will be nothing in Europe. But on Wednesday also we will be watching the crude oil inventories. However, we actually were not very optimistic about oil prices, even if crude oil inventories came in with a deficit, because despite the fact that OPEC has announced that there's a possibility to extend the production cut deal, the one that they reached in December, oil or crude oil right now needs action. We don't need just only remarks. Remarks are not even helping. They might help the oil prices to stabilize for a little bit, but not to push it above the 50 or above 55 or even $60. But going back to fundamentals, Thursday might be also the most important day as well to watch in the US, as we will be watching the US final GDP for Q4 of last year, in addition also to the jobless claims. Finally, though, on Friday, eyes will be first on the UK current account and the final GDP, but most importantly in Europe, we'll be watching the European Union inflation figures, which are likely to have a notable impact on the market ahead of the end of the month. Also in the States, also on Friday, there will be a bunch of data on that day, including the core PCE price index, which is the favorable inflation index for the Fed, which should be watched also very carefully, in addition to the personal spending, personal income, Chicago PMI, and the revised data of the University of Michigan Consumer Confidence or Consumer Sentiment Index. So this is it in terms of the fundamentals for this week and fundamentals that we've been watching for last week. Let's have a look right now at our weekly technical charts. Beginning with the US dollar index, and as we said last week, there was a potential head and shoulder formation or pattern was in place and in progress, and actually finally there is a confirmation of a breaking below the neckline, which basically stands right now at 99.35. And at the beginning of this week we had a gap lower in the dollar index, and this is, as I said before, on the back of what happened last week on Friday, and the decision by Donald Trump to pull the healthcare plan from the Congress and not to even vote on it. This is basically increases the chances that we might see more failures coming ahead during his presidency, especially the tax cuts. But despite all that, and the decline that we have seen at the beginning of this week,
I believe right now that might be the time that, or the time has come for the US dollar index to try and retest that broken support area, which is still a gap that might be filled in the next few days. And don't mind me about the gaps in the US dollar index, because that's normal actually. But for the time being, we have a very important support level that you need to keep an eye on, which is 98.54, because this is basically a support area, or it is actually 200-day moving average, which should be watched very carefully. In addition to that, this is also a support area, the one that we've seen before back in October of 2016. So I guess maybe at the end of this day, or at the end of Monday, we might hold above that support, and with a possible upside or a possible rally in the next few days, just to retest that 99.35 before crashing all the way back down. So we need the technical indicators like to take a breath for a little while before the trend continues. But for the time being, the bearish outlook has been confirmed, and we will be waiting for another leg lower, maybe somehow toward the 96 and even the 95. I wouldn't be even 96 or 95.40s. I won't be surprised if we decline so far. Going to the Kiwi. The Kiwi is still also suffering between the two moving average right now, which is, as we said, for the past few weeks. The 100-week moving average was very strong, and the Kiwi managed to rise. And last week, Kiwi managed also to rise, but it failed to break above the 50-week moving average. And this week, it seems to be very positive so far, even that there is some sort of a doji sign here, but technical indicators are still strong. So with a weaker dollar also that we're basically expecting for the next few days or for the next few weeks, there is a possibility for another run all the way to 70.95, and even above that level that could be possible. But don't forget that on the weekly chart we're still within the same range, so a break above the 50-week moving average might even push it all the way to 73.05, which is still a very good possibility in the next few weeks. The Aussie, again, another failure to break above the resistance area 77.22.21, and there's a lot of talks right now that last week there was some sort of an intervention by the Reserve Bank of Australia. But the good thing here is that the technical indicators are still flat on the RSI and also the RSI and stochastics, but still there is a possibility for more interventions by the Reserve Bank of Australia, especially if we break above the 72. So it seems to be that 72.20s, 72.50s is kind of a threshold for the Reserve Bank of Australia to stop the Aussie from rising. So I don't think so. This is still a very good buy here. I would stay away, and we'll be preferring like shorts, but on the longer run, not on the short term. The euro, finally today at the beginning of this week on Monday, gap up, and then we continued all the way up, and we continued all the way to 109 areas, which is a 200-day moving average. And so far we haven't been able to break above that resistance. I think so that the technical retracement from that level is kind of very possible. So in the morning or even during the US session, we haven't even posted any new highs. So this could be one of the reasons why I'll be looking for another down or leg lower to retest the 108.04, which should be very supportive and where I will be looking to buy again. Especially the technical indicators are positive, but they're heavily overbought. So I'll be looking for another again leg lower in the next few days, just for a short-term retracement before the rally continues. The dollar yen, it continued to go lower, breaking below the 11.64 as last week. It continues to go lower. The negative thing right now is that the 50-day moving average is crossing below the 100-day moving average. That's very negative sign. And it seems to be that for me that we will be looking for another leg lower, like for the next few days. Almost we might be looking this week toward 109.95. Well, we already reached there, 110 earlier this morning, but this is a very important level to watch, which is still, as I said again, a retracement for the dollar index is still possible. That's why the 50% Fibonacci for the US dollar or Japanese yen is still possible, but this would be also on a very short term to retest the 11.64 before declining again. The British pound, we're approaching the Brexit or the Article 50 trigger. Therefore, I still believe that the British pound has a little bit more room to break ahead. But don't forget, we're still some sort of around the same trend line resistance as I'm drawing in here. So I guess there's might be at the near the top of the current cycle, and we'll be looking for another, at least another leg lower toward 124.20s. But don't forget, again, as at the same time, don't forget that most of the Brexit impact is already there. So triggering Article 50 is not going to do that much for the pound in terms of pushing it lower, but the weak pound is here to stay, especially that the Bank of England needs it to stay weak to support also inflation and to support even exports. Finally, we'll be looking at gold prices, which continues to trade perfectly within our plan. Today we reached the 200-day moving average finally at the beginning of the session, which is a very important level, 120 or 1260. 61 is the year's high, but I still believe there is a very possible, or there's a very high possibility for a break above that resistance very soon, and we continue all the way to the next resistance area, which basically stands around 1260, 1290. That will be our next level to watch in the next few days. And even if we take the Fibonacci level here, or again we can draw it again here, so we're at exactly 61.8 here. So I will be still looking for another rally in the next few days, especially after we broke, or after we went down all the way from here last time and test and then all the way back up. So now we will be looking for a break above that resistance very strongly in the next few days after, again, a short-term retracement. The same scenario applies for silver, which is testing 200-day moving average. This is very positive. The technical indicators are still positive. There's no crossover to the downside yet in silver on the stochastic indicators with oscillator, which is still keeps the possibility for another rally in the next few days. But still, $19 is still our or at least, sorry, $18.50 is our target in the next few days, or maybe this week. But again, we need to watch some sort of a retracement in the US dollar first to the upside, and then we will be looking for another downside ahead. So this is in terms of our technical outlook for this week. So this is it for the week. Thank you for watching. If you have any questions, you can also leave it below, and if you like this video, you can share it on your social media platform. So this is it again for this week. I'll see you once again later next week. Have a good one.